Have you ever looked at your trading journal and thought, why did I do that? Not because you didn't know better, not because your strategy was bad, but because in the moment you broke your own rules. You moved the stop loss, you chased the breakout, you sized up out of nowhere. You took a revenge trade you knew you shouldn't take. And the worst part, you probably knew it was wrong while you were doing it. That's the part nobody talks about enough. Most traders do not fail because they lack information. They fail because they cannot consistently execute what they already know. So in this video, we're going to break down why traders break their rules even when the strategy is solid, what's happening psychologically in those moments, and how to build a system that protects you from yourself. Because the truth is simple. A good strategy is not enough. If your behavior collapses under pressure, your edge disappears with it. Let's get one thing straight first. If you have a strategy with real edge, but you can't follow it, then from a practical standpoint, you do not actually have an edge. Because in trading, the strategy on paper is only half the game. The other half is execution under uncertainty. And that's where people break. Not in the calm moments, not while backtesting, not while posting "discipline is everything" on X. They break in real time. When the candle spikes against them, when they've had 3 losses in a row, when the market is ripping without them, when they finally get one winner and suddenly feel invincible. Charles Schwab notes that traders can fall into loss aversion, self-attribution bias, overconfidence, and herd mentality, especially during sharp declines or soaring markets. Exactly the kinds of conditions where execution gets distorted. So this video is not about finding a magical indicator. It's about understanding the hidden forces that hijack your decision-making and make you sabotage a strategy that may actually work. And once you understand those forces, you can start building around them. The real problem: your rules compete against your emotions. Here's the first big idea. Your rules are logical. Your emotions are immediate. And in the moment of uncertainty, immediate usually beats logical. A trading plan says risk 1%, wait for confirmation, accept the stop, take only A+ setups. But your nervous system says, what if this is the move? What if I lose again? What if I get it all back right now? What if I miss it? That's why rule breaking doesn't usually feel irrational in the moment. It feels urgent. It feels justified. It feels like you're adapting. But often you're not adapting. You're reacting. CFA Institute describes this clearly. Investors are vulnerable to ego-driven bias like overconfidence, attention bias that overweights what is most vivid or recent, and emotion-driven decisions that confuse feelings with risk management. That is such a powerful point. A lot of traders think they're breaking rules because they're being flexible. But many times they're just letting emotion disguise itself as intelligence. They say, "I'm reading the tape. I just had a feeling. I knew it was going to reverse. I didn't want to get wicked out. I had to take the trade before it ran." Maybe. But if that keeps happening over and over and the result is inconsistency, then what you're calling instinct might just be undisciplined emotional decision-making. Reason 1. Loss aversion makes you protect your ego, not your capital. The first major reason traders break rules is loss aversion. Losses hurt more than equivalent gains feel good. So even when your plan says take the stop, your brain interprets that stop as something bigger than just a small business expense. It interprets it as failure. Schwab explains that once traders see a position fall below their entry, they often become reluctant to sell because realizing the loss is emotionally painful. And that reluctance can make losses worse if the stock keeps dropping. That is exactly why traders move stop losses. Not because they found new information, not because market structure changed in a meaningful way, but because accepting the planned loss feels psychologically heavier than staying in the pain a little longer. And that little longer is where small losses become account damage. You'll hear traders say, "I'll give it more room. It's just volatility. It'll come back. I don't want to get stopped out at the bottom." Sometimes that happens, but if that becomes your pattern, then your stop isn't a stop. It's a suggestion. And a strategy based on suggested risk is not a strategy. It's hope. This is where traders need to understand something brutally honest. When you refuse to take a planned loss, you are no longer protecting your capital. You are protecting your ego from being wrong. And the market charges a very high fee for that.
Reason 2. Recency bias rewrites your rules after a few trades. The second reason traders break rules is recency bias. This is when the most recent outcome starts feeling more important than the full data set. If you win 3 trades in a row, you feel unstoppable. If you lose 3 trades in a row, you feel like your system is broken. In both cases, you abandon objectivity. Schwab defines recency bias as placing too much emphasis on experiences that are freshest in your memory even when they are not the most relevant or reliable, and warns that it can lead investors to follow hot trends and deviate from carefully built plans. This is why traders constantly mutate strategies before they've even collected enough sample size. They take 5 losses and suddenly change entry criteria. Then they miss the next winner. Then they chase a random setup. Then they size up after one big win. Then they wonder why nothing is consistent. Because they are no longer trading a system, they are trading their last emotional experience. That's a huge difference. A good trader understands that a single trade means almost nothing. A small cluster of trades means very little. The strategy has to be judged over a meaningful sample. But emotionally, that's hard, because every recent trade feels like proof. A recent win feels like proof you're a genius. A recent loss feels like proof the market changed. A missed move feels like proof you need to be more aggressive. A fake breakout feels like proof breakouts don't work. And before long, your strategy becomes unstable, not because the strategy itself is weak, but because you won't leave it alone long enough to measure it properly. Reason 3. FOMO creates rule breaking through urgency. The third reason is one of the biggest killers in trading: FOMO, fear of missing out. And FOMO is dangerous because it compresses your time horizon. Normally, your plan says, wait for confirmation, buy at the level, only take setups that meet criteria, don't chase extension. But FOMO says, if you don't act now, it's gone. Investor.gov warns that hype, influences, trendy assets, and market swings can push people into investment decisions driven by fear of missing out instead of a long-term plan, and explicitly advises investors to say no-go to FOMO. That same mechanism shows up in trading every day. You watch price move without you. Then, suddenly your setup standards collapse. Now you're entering late. Now your stop is wider. Now your risk to reward is worse. Now you're taking a trade you would never have taken 5 minutes earlier. And the irony is brutal. The thing you fear most, missing the move, often causes the exact behavior that produces the worst entry. FINRA also notes that hype-based schemes exploit FOMO by adding urgency and making people feel they must act immediately or lose the opportunity forever. That urgency is the point. Urgency bypasses analysis. When you feel rushed, your standards drop. When your standards drop, your edge weakens. When your edge weakens, your losses rise. And then, after the loss, you say, "My strategy doesn't work." No, you didn't follow the strategy. You followed urgency.
Reason 4. Overconfidence makes traders think rules are for other people. Now let's talk about the most seductive reason traders break rules: overconfidence. Because fear makes you sloppy, but overconfidence makes you reckless. After a few winners, traders start feeling like they've figured it out. They size up too fast. They stop waiting for confirmation. They skip journaling. They improvise exits. They start believing they can bend rules because now they understand the market better. CFA Institute identifies ego-driven bias as overconfidence, the belief that our insights are more accurate and our decisions are better than average. This is why some of the worst damage in a trader's career doesn't come after losing, it comes after winning. Because winning lowers caution. You stop respecting variance. You stop respecting risk. You start confusing a good streak with permanent skill. And then the market reminds you. One oversized position, one emotional hold, one refusal to lock profit, one revenge add-on, and suddenly you give back 3 weeks of disciplined work in one afternoon. Schwab specifically warns that in soaring markets, traders can become overconfident, let positions stay open too long, take on too much risk, and ignore red flags that could signal reversal. That's why mature traders don't just manage downside emotion, they manage upside emotion too, because excitement is just as dangerous as fear when it makes you stop following process. Reason 5. Traders use rules only when willpower is high. Now this next point is massive. A lot of traders rely on motivation instead of structure. They follow rules when they feel sharp, calm, and inspired. Then they break rules when they're tired, stressed, frustrated, or overstimulated. That means their discipline is state-dependent. And if your discipline only works when you feel good, it's not discipline, it's mood-based compliance. The American Psychological Association explains that self-control can be strengthened by avoiding temptation and by using implementation intentions, if-then plans, that decide in advance how you will respond when a challenging moment appears. The key benefit is that having a plan ahead of time helps you act in the moment without having to rely entirely on willpower, source. That is gold for traders, because most rule-breaking happens too fast for deep reasoning. You don't have 5 calm minutes to debate with yourself while a candle is ripping, your P&L is flashing, and your heart rate is elevated. So instead of saying, "I just need more discipline," a smarter trader says, "I need pre-made decisions." For example, if I take 2 losses in a row, then I stop trading for 30 minutes. If I feel the urge to move my stop, then I step away from the screen for 60 seconds first. If price runs without my entry, then I let it go and wait for the next setup. If I break one rule, then I reduce size on the next trade or stop for the day. That is how professionals reduce damage. They don't expect themselves to become emotionless. They build systems that make emotional mistakes harder to execute. Reason 6. Traders secretly want certainty from an uncertain game. Here's the deeper truth under almost all rule breaking. Most traders have not fully accepted uncertainty. They want a strategy that removes discomfort, but no real strategy can do that. Even a profitable strategy has losing streaks. Even a clean setup can fail. Even perfect execution can lose money. And until you emotionally accept that, you will keep trying to fix the discomfort by breaking rules. You'll exit early to avoid stress. You'll hold losers to avoid being wrong. You'll chase entries to avoid regret. You'll overtrade to avoid boredom. You'll change the system to avoid doubt.
Investor.gov warns that tools driven by social sentiment and real-time crowd discussion can encourage emotionally driven or impulsive decisions, and advises investors not to let short-term emotions disrupt long-term objectives. That principle applies to traders too. If you need every trade to feel good, make sense immediately, and reward you fast, then your emotions will keep overruling your method. Because trading is a probabilities business, and probabilities feel uncomfortable in real time. The mature shift is this. You stop trying to feel certain, you start trying to be consistent. That one shift changes everything. So how do you actually fix this? Not with more quotes, not with more motivation, not by saying, "I need discipline" for the 100th time. You fix it by reducing the number of decisions you make under emotional pressure. Here's how. 1. Turn your strategy into a checklist. If your setup rules are vague, your emotions will fill the blanks. So define your entry, stop, target, size, time of day, and invalidation criteria in writing. Clarity reduces negotiation. 2. Pre-commit to exits. Schwab recommends creating an exit strategy before placing the trade, including tools like stop orders, because upfront commitment helps remove emotions from the selling process. In other words, decide before you're emotional. 3. Use if-then rules. This comes directly from the APA concept of implementation intentions. If X happens, then I do Y. No debate, no interpretation, no in-the-moment creativity. 4. Trade smaller when emotionally unstable. If you're coming off a big win, a bad loss, poor sleep, or high stress, reduce size. Smaller size protects decision quality. 5. Review behavior, not just P&L. A green day with bad process is dangerous. A red day with perfect process can be excellent. If you only reward profit, you will train yourself to repeat lucky but flawed behavior. 6. Build pause triggers. If you break a rule, take a mandatory timeout. If you feel revenge trading energy, pause. If you feel euphoric after a winner, pause. The pause is not weakness, it is damage control. 7. Measure over sample size. Morningstar's long-running Mind the Gap work highlights that investor timing behavior can reduce actual returns relative to total fund returns, reinforcing the cost of behavior-driven decisions. Same lesson here. Stop judging your strategy by one trade, one day, or one emotional moment. Judge it over enough data to be real. So why do traders break their rules even with a good strategy? Because the real opponent is not the market, it's the part of you that wants relief more than consistency. The part that wants to avoid pain, the part that wants to feel smart, the part that wants the move right now, the part that thinks one more click will fix the day. That's why success in trading is not just strategy design, it's behavior design. The traders who survive are not necessarily the smartest, they're the ones who build systems strong enough to protect them from their own worst impulses. So if this video hit home, don't just ask, what strategy should I trade? Ask the better question, what system do I need so I can actually follow my strategy under pressure? Because that is where the real edge begins.